So they told you the big beautiful bill would finally make homes affordable, but every time they do a law like this, housing gets more expensive and ordinary buyers end up losing. So they call this historic progress, but look at the data. Affordability keeps getting worse every time laws are passed like this, and you can't fix housing by simply throwing money around with ignoring the structural changes that need to happen within the real estate industry. So let's dive in. How does the big, beautiful bill impact housing in the future long-term housing markets? So this is a really important quote from Ray Dalio. He's one of the most prestigious hedge fund managers out there. And I just want to read this aloud to get this started because he has been tracking the debt cycles and has written multiple books on it, something you need to pay attention to. So now that the budget bill has passed Congress, we can see what the projections look like for deficits, right? And the bill was signed the other day. Deficits, government debt, and debt service expenses. In brief, the bill is expected to lead to spending about 7 trillion a year with inflows of 5 trillion a year. So the debt, which now is about 6x of the money taken in, 100% of GDP and about 230,000 per American family. Wow, that's crazy. 230,000 per family will rise over 10 years to about 7.5x the money taken in and 130% of GDP. That sounds like Greece. If any of you have seen what happened with Greece, you know, it's pretty similar, and $425,000 of debt per family. That will increase interest and principal payments for the debt from about 10 trillion, 1 trillion in interest and 9 trillion principal to about 18 trillion. Wow. Of which 2 trillion is interest payments, which will lead to either a big squeezing out and cutting off of spending and unimaginable tax increases, right? This is what happened in Greece, or a lot of printing and devaluing of the money and pushing interest rates to unattractively low levels. Well, this is what they're already calling every single day. And Trump said it the other week, let's reduce the Fed funds rate to 1%, right? About a 3% drop, a little bit more, which is crazy. The printing and devaluing is not good for those holding bonds as a storeholder of wealth. And what's bad for bonds and U.S. credit markets is bad for everyone because the U.S. Treasury market is the backbone of all capital markets, right? Which are the backbones of our economic and social conditions. Unless this path is soon rectified to bring the budget deficit from 7% of GDP to about 3% of GDP by making adjustments to spending, taxes, and interest rates, big, painful disruptions will likely occur. So the bond vigilantes are going to be out there, and we could see actually interest rates going up because of the expectation that we're spending so much money, the value of our currency is going down, and we're going to see a massive impact from inflation down the line if we don't make changes now. This is what you guys are my family now, so I appreciate you watching my YouTube channel, but this is what I sent out to my real estate agents and to my family. So with the BBB passing and being signed tomorrow, hedge fund manager Ray Dalio had that message I just showed you. You're my family too, so I'm sharing the messages between my family this evening as we discuss paths forward for a long-term wealth building, considering a new market environment. Fiscal and monetary policy markets absolutely drive the markets, the biggest impactor. So the debt crisis is nothing new. No politician is going to lose their career to fix our debt crisis and stop handing out goodies to the constituents. We see this on both sides. This is not a political statement. This is just the fact, and the reality is politicians will say whatever they can do to get into power. And then once they get into power, they just continue to spend. It's a really big problem in the United States. The only problem is that the debt is compounding faster than our GDP growth. So we'll have a crisis, the devaluation of the dollar and high inflation. So if you really want to think about what are great inflation hedges, and I'll get into real estate because I don't think it's actually the best hedge in this circumstance. Good inflation hedges are equities. I personally like the AI stocks, commodities, and gold. And by the way, this is not financial advice. You need to figure this out for yourself. This train isn't stopping. The only way a politician will take the debt problem seriously is when the bond market forces us to take the situation seriously, and we have no idea when that'll be. We saw a glimpse of that earlier last month when we saw rates skyrocket on, you know, basically bond vigilantes saying, "Hey, the U.S., you're borrowing way too much. You guys need to cut from your bill," and they didn't. And so we've seen rates go up. You know, obviously we had a really great employment print last Friday, and we saw rates go up then, and we saw them go up about 10 bips in the last 2 to 3 days. We'll see what happens this week. Highly recommend buying equities as soon as possible. This is what my preference is, especially if Powell quits or get removed and they reduce the rates to 1%. All assets will rip upwards, and the printing and monetary policy, both of them, will make the rich richer and the poor poorer. Comment below if you believe that to be the truth. We're just seeing a huge wealth divide. We'll always share what we're up to. In 2022, we shared with our agents that they need to sell their rental properties because we saw interest rates moving up. And we know that when rates go up, asset prices go down. So this is, again, not financial advice. This isn't political. This is information for you to consider so you can make the best decision for you and your family. I think it's important for everybody to take a look at this really deeply. One of the main issues that we've seen is that there has been a massive wealth gap in the United States, and this bill is going to make it, honestly, just continue to go that direction. Since 1989, the share of American household wealth by top 1% has increased by more than 60%. For comparison, those in the 99% to 99.9% increased about 20%. Those who are in the wealth is in the 90 to 99% fell 4.1%. Those in the 50 to 90% fell 17%, right? So this is how inflation crushes the people who don't have any money. And the bottom 50% of the population has fallen about 46% of their share of national wealth. This comes from the US Federal Reserve. So the bottom 50%, their wealth has dropped 46% since 1989. And that is because the government continues to print the dollar. And when they print, inflation causes people who have assets, their assets go up in price. People who don't have assets, things just become more expensive for them, especially if wages don't keep up. So it's a horrible thing for the country overall, and it erodes the middle class. And unfortunately, that's what politicians on both sides, Democrats and Republicans, continue to do when they get into power, even if they promise the exact opposite on their campaign trails. So here's something that we've seen. The money supply just continues to take off. This is, because of printing of money. The M2 money supply from May 2025. You can just see we had a slowdown there on the money supply. That's because the Fed let the assets roll off their balance sheet, the mortgage-backed securities and treasuries that they bought back from the 2020 period. We saw this spike, and then we saw it kind of roll off the balance sheet, and then they're starting to buy again to keep interest rates and manipulate interest rates to keep them low. So this is absolutely insane. So Kalshi is a betting website. You should take a look at it. It's got some really interesting trades on it. But now the U.S. debt is expected to hit 40 trillion this year per Kalshi. So put that in perspective. At the start of 2020, the total U.S. debt stood at 23.2 trillion. This would mark a $17 trillion increase in 6 years. Never in history have we borrowed even remotely near the levels that we are borrowing now. In fact, I think I read that Trump is this bill is basically double what any other president has ever, considered doing from a spending project. So we hoped for something different. I was a big fan of Doge and Elon Musk going out there and cutting waste, fraud, and abuse. I think that's a great thing. Obviously, they moved really quickly with a sledgehammer when they could have used a scalpel. I get it. They have to move quickly because Congress will get in the way. But this is basically what we're seeing, right? The Republican Party is moving towards bigger government, nanny state deficit spending, and war. And the conservatives out there, they want limited government, free trade, and balanced budget. So I don't know what's going on with the Republican Party. It seems like there's all of the things that they had stood for going out the window when they get power of the purse. Like, it's no different than how the Democrats are. But this is actually a picture from 20 years ago, which is pretty crazy. It's something that continues to go on today, and it just continues to rhyme. And again, whoever's in power is just going to hand out goodies to their friends. So how does it impact real estate, right? So it's initially going to have immediate sugar rush, right? We're printing money, we're putting money out there through fiscal spending, fiscal and monetary policy. More money chasing fewer units will cause inflation. Okay, so the prices of assets will go up with this type of spending. Then a sugar crash, right? So if you spend way too much, and this is Dalia's point, at some point the bond vigilantes will come in and say, you're too much of a risk for us to bet on. We need to charge you more interest to satisfy that type of risk. So that could mean higher treasury rates, higher mortgage rates, and ultimately that would make things even more affordable, right? If we have higher inflation, right, prices go up and then mortgage rates go up, it'll just make things way more unaffordable to the average buyer, which is already an all-time low. We have statistics showing that 68% of consumers are already living paycheck to paycheck, When inflation goes up, those 68% are the ones who are getting hit the hardest because they're spending their entire paycheck. Okay. So they don't have the ability to save and buy assets and benefit from inflation going up. So, how does the big, beautiful bill impact real estate specifically? Consumers, this is basically a lot of things were made permanent. So permanent mortgage insurance deduction, right? So when you borrow money, you can now deduct your mortgage interest premiums, your PMI, your FHA MIP, your VA funding fees, your USDA guarantee fees, subject to specific income limits. So you can now deduct these fees when you go to buy a house, which is great. And permanent, these are all permanent things. These were temporary, now they're permanent. Permanent 750K cap on the mortgage interest deduction. So you can deduct your interest on an acquisition of debt of $750,000 for example for your primary residence, which is great, so you can write that interest off that supports home ownership. An expansion of low income housing tax credit, which makes it more affordable for rental housing. Those are some things that were in the big beautiful bill that helps out the consumers and makes some things permanent. How does it help investors? Another permanent thing, they made the 20% deduction for QBI, the qualified business income. Most rental real estate qualifies as a trade or business under IRS guidance. So if you spend enough certain number of hours per year in real estate, you can then actually deduct the net rental income, which lowers your effective tax rates, makes the value of your real estate more valuable. So it's a good thing for real estate investors. The 5 trillion of the federal debt ceiling increase, right? So it also included, another 5 trillion that they can spend. While it's not a direct impact on real estate, it impacts real estate by adding U.S. Treasury backed liquidity, right? So now they can spend up to that amount. We don't have to have this debt ceiling type crisis every single year where they have to revote to increase the debt ceiling and it comes down to a deadline and a bunch of negotiations. There's no federal down payment assistance options, so this is kind of negative. With no federal help, you need to get hyper local and basically work with your state and your local government to get those first time home buyer down payment assistance programs. And this should say 1031 exchange. So investors can defer their capital gains when selling and reinvesting their new properties, right? So they can defer the amount of tax that they pay when they transfer their assets, their real estate assets. But the reality is, it's actually bad for investors and for consumers. So the CBO, the Congressional Budget Office, projects more accurate over the short term than the long term. Okay, so this is just a cool chart from Congressional Budget Office. They have a good idea of what the short term impacts will be from changes, but the long term impacts they are not as accurate on, and they can actually be off by quite a bit. But this chart's pretty interesting. You can see how fast the federal budget is actually moving upward, and they can see like over the long term their projections of the debt is actually, for the most part in the last few years, their projections have been pretty low relative to what it actually came out to be. So it's starting to look worse and worse. So this is the US federal debt as a share of the economy since 1790. And you can see that it is just starting to skyrocket. Obviously, we had this huge funding in World War II, which needed to happen to protect our country. And then we had the Great Recession that brought things down. And then once we had the 2020 period, it just skyrocketed with a bunch of goodies being handed out to everybody. And those programs basically becoming permanent now. So we just continue to spend more and more. It's becoming a larger amount of GDP. As Dali was mentioning, we are at 100% of GDP for our federal debt, and now we're skyrocketing up to 130% over the next few years here, which is really scary. Those numbers are quite outrageous. And once you get a debt snowball like this, it's really hard to come back from this. So I thought this was a pivot point, and I was hoping that the administration would actually do what they promised on the campaign trail and try to cut spending. There's no way that we can outgrow this level of spending. You have to cut somewhere. How they figure out how to do that, I don't know. If they're going to have to raise taxes in the future, I don't see a way out of that. Tariffs, frankly, are just passing the fees onto the consumer. It's just another form of inflation. Goldman Sachs came out with a report saying that 70% of the tariffs will be passed on to the consumer. So it's not really helping the consumer. It's hurting the consumer. And inflation is basically a secret tax on the consumer. So when you really look at it. And because they're printing so much, and look at this chart, the purchasing power of the dollar, this is from Bravos Research, continues to just move down dramatically. So the value of your dollar just, even if you're making more, I think it was like something since the beginning of the year, the purchasing power of the dollar has dropped already 10%, which is just crazy. It's like the worst year ever. And with this type of bill, it's likely that the US dollar will continue to lose its standing in the world. And of course, we see the credit default swaps continuing to move up. So this is the risk that the US government might default on their debt. And so America can become a credit risk again. So I expect fully that we see treasury rates, especially long-term treasury rates, move upward, which will impact mortgage rates, which would move upward. And if that happens, again, we're at an affordability crisis already in housing. It could make things a lot worse. So who does it help? This was from May 2025. Now, a lot of this stuff made it through, a lot of it didn't, but it gives you a good idea. Hey, when this big, beautiful bill goes through, it's mostly helping the top income earners and it's hurting the bottom level income earners. Of course, there's some cool things like there, like no tax on tips and no tax on overtime pay and things like that, which is great, though the majority of the gains go up to the top. This is just a bill that is very clearly for a lot of people, especially if they're on Medicaid. Florida specifically is going to be impacted by the Medicaid changes. So here's the impact on the deficit over the next 10 years. Okay, so make the 2017 individual tax rate cuts permanent. That was the biggest thing, is making them permanent. Now, if you listen to certain analysts, they're saying, well, this doesn't change your current law. This is how the current law is. This just makes it permanent. And we want to remove that $2.1 trillion from the 2017 individual tax rate cuts. So they don't want to consider that in these projections. Well, unfortunately, that's how you have to do projections from the CBO and to keep things consistent. Increased standard deduction, the increase in the child tax credit, which I think is really good. The border and immigration spending, I think absolutely. I don't know if any American thinks that we shouldn't have a border. Absolutely, we should have a border. Military spending, no taxes on overtime, tips, and interest on loans for U.S. made cars, which was something that was added in there. Additional deductions for seniors, change to student loan payment plans, right? So people with student loans are not going to have access to certain loans anymore. Phase out of Inflation Reduction Act tax credits. So some of the tax credits are going away, like we saw with Elon's, electric vehicle tax credits. And then the Medicaid cuts were the number one thing that were cut. So this is where the impact is going to happen over the next 10 years. As I mentioned, Florida will be the most impacted with these Medicaid cuts. There's projected about 2 million people who will be impacted by this policy change. And some people think that this is good. Some people think that this is bad. Comment below what you see there with the policy changes. But, this is going to impact housing. If people are not able to afford health insurance, it's going to be a big problem if they're not making as much money anymore because they have to buy insurance elsewhere. So work requirements is the number one thing. You can debate that till you're blue in the face. Make it more difficult for states to fund Medicaid. Repeal rules simplifying eligibility and renewal. Check Medicaid eligibility more frequently. Other and limit payments to providers. So this is from the CBO, and millions of frankly will lose access to Medicaid around the country. Florida will be impacted the most out of all the states, when Florida is already one of the states that's getting hit the hardest with a bunch of other, factors and economic factors, such as 80% of migration is down to Florida from the peak. So, now the people who live here at the bottom are going to be hit even harder from the Medicaid situation. Now, here's the largest pieces of the deficit as a percentage of the GDP. This is a really interesting one. So you can see the interest on the national debt is starting to skyrocket. That's that red line there. And this is the big scary thing where it can get up to being more and more percentage of GDP. And that could happen very quickly should long-term interest rates continue to rise. Medicaid and Medicare are the number one factors. Then you see Social Security. So those are our social programs, right? Social Security, Medicaid, and Medicare are our biggest spending, which are basically, our way to help elderly people have insurance and get income as they go into their older years. Non-defense discretionary, and then defense discretionary. So we're spending about 3% of our GDP on our defense budget there. So we're starting to see look at that increase from Medicaid and Medicare just continue to go up as we have aging demographics in the United States. Here's a good chart. This is where you can clearly see where money's coming in, where it's coming out. It is from 2023, so it should be updated. But you can see that, look, Social Security and Medicaid are one of those things that are the biggest spending the national defense for veterans, assistance to individuals, net interest on the debt, which is the problem. It keeps going up. Transfers to states, right? Other spending. And then this is where our tax revenue comes from: individual income taxes, payroll taxes, corporate income taxes, which is quite low. I think a lot of people are surprised to see that. Customs duty, sales and excise taxes, and others, right? So Trump has his tariffs out there. Again, a lot of those tariffs basically is a form of tax on the consumer, which you can argue if you want to, but that's just like those are the smartest people in the world are saying that it just gets passed on. Yes, some of it gets passed on to, along the supply chain, but the majority of it does get passed on to the consumer. And then the remaining amount is the deficit, which we have to finance each year and continue to go into more and more debt, which just blows up that net interest on the debt. So, in summary, look, this bill is going to have a short-term boost to housing, and I think we're going to see, prices potentially turn around here. It all depends on what they're going to do with the monetary policy. So, if they reduce rates to 1%, we could see a rush into the market for housing, and then it'll actually blow prices out. And then I think we're going to have some sort of bond crisis here, definitely within our lifetime, most likely within the next year or two or three, basically because the bond vigilantes are going to say we need to have a higher return for how much your country is spending at the current moment. So I think we could see a short-term boost here and a long-term loss to housing, because the affordability crisis is just going to get worse and worse for the majority of Americans in the middle class, and it'll just depend on when these bond vigilantes step up. So look, if you have questions, drop them below. I'd love to talk with you more about this. Any insights you have, or what are you thinking about this big, beautiful bill and how it's going to impact the housing market long term? We'd love to hear from you. As always, you can subscribe to my Substack. The information is below. I talk about things on there I can't talk about on YouTube. And with that, I love you guys. Thanks for watching, and I'll see you next week.